Okay, so let's talk about Varun Beverages, or VBL. This company has been one of the market's absolute monster growth stories for a while now. But after an incredible run, the stock's kind of hit a pause button. So the big question on everyone's mind is this just the stock catching its breath before the next big surge, or is the party over? Well, in this analysis, we're going to break down their whole strategy, the risks, and what the data is telling us about VBL's next big move.
The core of the VBL story is this really powerful transformation. They went from being just a simple bottler to this massive, diversified beverage powerhouse. And the engine behind all of that? They call it their asset-right growth model. Basically, a super smart strategy of buying and integrating other businesses. And the result? You're looking at it, a staggering 51% compound annual growth in profits over the last 5 years. That's just incredible.
All right, here's how we're going to break it all down. First, we'll dig into how VBL built this powerhouse. Then we'll look at the bull case, all the reasons to be optimistic. After that, we'll cover the bear case and the headwinds. We'll wrap up with a look at valuation and technicals before getting to the final investor verdict.
Okay, so let's start at the beginning with the foundation of VBL's success. What is their competitive advantage? Their moat? I'll give you a hint. It's a lot more than just a bunch of bottling plants.
Here's the real secret sauce. VBL's true competitive moat isn't the factories. It's their absolutely massive distribution network. They control basically everything from the bottle caps to the delivery trucks, which lets them reach 3.5 million retail spots. Think about that. And because they control the whole shebang end to end, that's how they've managed to keep these really robust 23% EBITDA margins, even when inflation was going crazy. It's a powerful defense.
All right, that's the foundation. Now for the really exciting part, the bull case. With a core business that's so strong, where does the future growth come from? Well, VBL is definitely not standing still. They are firing up several new engines as we speak. A huge piece of this bull case is what they're calling the Africa plus snacks pivot. It's pretty straightforward. They're expanding aggressively into Africa and at the same time pushing hard into the higher margin snacks business. And this isn't just some plan on paper. A new Cheetos plant in Zimbabwe just came online this past February. Spearheading that whole Africa strategy is the big push into South Africa. We're talking the continent's largest beverage market. They got in by acquiring a company called Bevco, which was a really smart, low-cost way to enter. And now that the integration part is done, the focus is 100% on execution, using their expertise to make that distribution network way more efficient. And let's put a number on that snacks opportunity, because this is not some small side project. Management is actually guiding that the snacks business, especially in Zimbabwe and Morocco, is on track to become a $100 million revenue engine. And get this, by the end of this year, 2026. That is a serious push into high-margin foods.
But wait, there are two other powerful growth levers here. First, they're getting great margin expansion from their incredibly popular Sting energy drink portfolio. And second, they're making a big strategic move into alcohol distribution through a brand new pact they just signed with Carlsberg. So, lots of things happening.
So you might be asking, how in the world are they paying for all of this expansion? Well, they're sitting on a massive pile of cash. A recent 7,500 crore rupee fundraise lets them invest aggressively in all these new markets without putting any debt on their core India business. That is a huge strategic advantage, funding all this growth from a position of serious financial strength. Okay, that's the bull case, and it sounds pretty compelling. But to get the full picture, you have to look at the other side of the coin. No company is immune to challenges, so it's absolutely crucial we understand the headwinds that VBL could be sailing into. The bear case really boils down to 3 key risks. First, and this is a big one, is the weather. It's a real threat. Unseasonal rains in 2025 actually slowed their revenue growth down to just 8.4%. Second, competition is heating up. You've got rivals like Campa-Cola putting pressure on pricing. And finally, that big push into Africa, well, it comes with currency risk. Volatility in places like Zambia and the DRC could definitely put a dent in their overall earnings. So we've got the big strategic growth story, and we've got the risks. Now let's see how all of that translates into the stock's valuation and what the charts are telling us right now. So when you zoom way out and look at the long-term monthly chart, the picture is pretty clear. It's been a powerful, sustained uptrend for years. The stock created massive wealth, hitting new all-time highs right around the middle of 2024. And that context is really important for understanding what happened next.
Okay, so let's focus on the recent action. After that huge run, the stock pulled back a healthy 23% from its highs, and now it seems to be finding a floor, stabilizing around that 458 rupee mark. For you technical analysts out there, a key indicator is the RSI, the Relative Strength Index. It's getting close to oversold territory, which might suggest that this recent wave of selling is kind of running out of steam.
So, the million-dollar question. Is it expensive? Well, the price-to-earnings ratio is 53 times, which, let's be honest, is a premium compared to other FMCG companies. But here's the justification from the bull case. You're paying a premium for a massive 51% 5-year profit CAGR. The whole debate really comes down to whether that high growth can continue and justify that high price tag. All right, let's bring it all together. We've seen the powerhouse business model, the exciting new growth engines, the very real risks, and the premium valuation. So what's the final verdict from the source material on all this?
The final verdict is that Varun Beverages remains a structural compounder. Now, that's just a fancy way of saying it's a company that's built for consistent long-term growth. So that recent 23% drop? It's not seen as a crack in the foundation. Instead, it's being viewed as a healthy valuation reset, which could be creating a more attractive entry point for long-term investors.
And that leaves us with one big final question. You've got this major strategic pivot into Africa and snacks accelerating just as we're heading into the peak season of 2026. And the stock price has just taken a breather. So, is this period of consolidation just the prelude, the calm before the next explosive move up? That's the strategic crossroads VBL finds itself at today.